Day at around 8:30, we will do a fundamental stock check on markets with Prakash Diwan, who will be with us on the program.
All right, so let's begin the show then. On the equity side, first up, we have Chetan Seth of Nomura, who says stocks were softer again this past week as recent US data surprises caused significant uncertainty on the near-term US data and thus the trajectory of US inflation growth and the Fed outlook. To add to the surprises, he said this past week, the US core PCE came in even higher than the already elevated street expectations. This reading, in his view, will likely further raise market concerns that inflation is proving to be stickier than expected and likely a more aggressive Fed and thus a near-term risk coming in for equities.
All right, so money market views as well. B. Prasanna of ICICI Bank says as activity data in the US continued to surprise on the upside, terminal rate and front-end yield curves were repriced higher, triggering broad-based dollar strength. He says the rupee was supported by improved external outlook owing to healthy services export, might now trade with weakening bias against the dollar, calling EM currencies. He expects the dollar INR to trade in a range of between 82.4 to 83.4 to a dollar, with likely RBI intervention to keep it within the range.
All right, and on the bonds, B. Prasanna says global yields remain elevated as strong economic data and resilient inflation prints led to expectations of higher for longer terminal rates. He says domestic yields also came under pressure despite favorable demand-supply outlook as inflation outlook appears grim, resulting in possibility of more hikes by the MPC. He expects bonds to trade cautiously with the 10-year benchmark bond yield ranging between 7.3 to 7.5%.
All right. Well, Ed Yardeni is with us now, president at Yardeni Research. Ed, good to have you with us here. Thank you very much for your time. So once again, I mean, global markets are looking problematic, aren't they? Is the US starting another leg down, in your opinion, yet, Ed?
I don't know if it's a leg down. I think that this has been a volatile market since last year. Last year, we had a bear market. I still think the October 12th low was the low in that bear market. I think we're in a bull market, but it's not going to be a V-shaped bull market, more like a U-shaped, probably mostly because stocks aren't exactly cheap. But to answer your question directly, I think what really has changed during February is a perception that instead of arguing over soft landing versus hard landing, we have to now consider no landing. And I think what the market's concerned about recently is an inflationary no landing, which would just be a long way to a hard landing after all, because the Fed would have to raise interest rates much higher to get inflation down.
So what do you think, Ed, is the end game for this in terms of what the equity market participants should expect? If interest rates are moving higher, if there is a recession coming through, growth is slowing down, do you think that equity markets have priced most of that in already, or do you think there's more to go on the downside, especially for a market like India?
Yeah, well, in the U.S., we're down just below our 50-day moving average. It's not going to take much more of a fall to get to the 200-day moving average. My thinking is that we're going to see quite a bit of volatility around the world, including India, mostly because the Fed is driving concerns about still higher interest rates. Look, the Fed has made it very clear they're not even thinking about lowering interest rates. So I don't know why the market continues to try to figure out when rates are coming down. I think at this point, we just have to figure out the terminal rate. And I still think it might be 5.25%, though the markets are at 5.4%. But whatever it is, I think it's going to happen pretty soon. And then I think it's going to stay there, which is going to keep the markets, I think, under some lid pressure from the fact that you can get some pretty good return in the money markets.
All right. Hi, Mr. Yardeni. Good morning. In the past, you've said that long-term investors who are looking at emerging markets, they'd rather be in India than China. Do you hold on to that view? And do you think bulk of that China reopening trade has played out?
Well, I think that a lot of this is going to be related to the geopolitical situation, and the geopolitical situation is more and more favorable for investors to look at India as an important growth market. There's been a lot of articles recently about the relative demographics, that China's demography is rapidly aging and the population is slowing, actually declining. And then in India, meanwhile, you still have a growing population that's relatively young within a democracy. So I think India is continuing to get a lot of very positive buzz. but it is an emerging economy at this point. I know Modi would like to make it a developed economy, and that's a great ambition. But I think at this point, as an emerging market, it gets buffeted around by what the Fed's doing and what the dollar's doing. So as you folks said, concerns about the Fed having to raise rates some more have caused the dollar to go up, which is not a good environment for emerging markets.
Well, we will leave it at that, Ed. Thanks a lot for giving us a quick take on what the global setup is looking like. Not looking very good at the moment, of course, but let's see how things progress from here. So we do have a weak global handover, and our own markets have also been under pressure. What does that mean for individual stocks? We'll take a quick commercial break. On the other side of the break, our entire team will be with us to help us prep for the trading day. Stay tuned.